So maybe if each one of you could spend 30 seconds introducing yourself first. Ben?
Okay, sure. Hey everyone, good morning, good Monday morning. My name is Ben El-Baz. I'm a graduating student from the GSB at Stanford. Over the last year, I co-founded one of the largest blockchain groups at Stanford called the Blockchain Collective. I was a part of the early student founding team of DTI here at Stanford. And just been really excited about blockchain and cryptocurrencies for the last 5 years. The last year, I've spent a lot of time thinking about crypto economics, thinking about how these systems can create stronger incentives for running any type of system. So I'm happy to be here on this panel to talk a little bit about my ideas and thoughts and share some things of value with everyone.
So hi, my name is Jochen Kumm, a long veteran of Stanford, but no longer here. In the last year, we founded Healio, and we are essentially dealing with one of the problems that Jan laid out, which is the fact that there's value in biogenomic data. We know how to process it, and in some sense, we are consumers and designers of blockchains because we are asking the question, how do we enable privacy, ownership, monetization, and use of data in a way that is actually functional and satisfies the customers. So we're very much sort of in the trenches trying to figure out how to make that work.
Hi, my name is Clint Korver. I'm a managing director and co-founder at Ulu Ventures. We're a seed stage venture firm here in Silicon Valley. We focus on enterprise IT, big data, fintech companies, and recently have been making some blockchain investments.
Great. Well, Clint, I don't want to call you a traditional venture capitalist because you're certainly more open-minded. But when you look at blockchain companies, it must at first sight be a little bit confusing. There's a lot going on. There's the founders, there's equity, there's tokens, token economics, there's multiple jurisdictions, there's a moving regulatory landscape. So how do you wrap your head around this, and how do you start to evaluate things?
Sure. So one of the things that makes us different, we think, from most venture firms is we take a very data-driven, analytic approach to our decision-making. And what you see on the screen up here is a high-level picture of the model we use to evaluate blockchain companies, and in particular, blockchain companies where there's an ICO and tokens involved. And I'll just spend a couple of minutes walking through our thinking when we evaluate startup companies. So on the very left-hand side in the middle, we have what we call category market transactions. And this is a proxy, if you will, for the value you're creating in the marketplace, which at the end of the day, that's the core thing that's going to drive a successful company. But this is what we can measure. It's like, are people using your tokens to transact? And if we follow the path on the top, if you look at that divided by token velocity, it gives you some intrinsic notion of the category's token market cap. Now, by the way, this is the category. This would be like for healthcare data or identity data or financial services data. If you're doing a startup, you're only capturing a portion of that market opportunity, and that's represented by market share. So if you look at market share and intrinsic category token market cap coming together, that represents, from our point of view, the intrinsic value of the company you're creating on the token side. Now, of course, there's speculation in there as well, which can sometimes distort things. I'll come back to that in a moment. Now let's follow the bottom route. Again, starting out with the value you're creating in the marketplace. Your business model, the lower left-hand corner, is your ability to monetize the value you're creating in the marketplace. This would call it in sort of a traditional equity sense. So those two things come together to drive your total addressable market. Again, factor in market share to look at the potential revenue of your company. And then if you build a meaningful company, there are comparables out there so you can figure out, well, what's your company worth in terms of a revenue multiple and the company exit. So these are, if you will, two paths to figuring out token value and equity value. And one of my key decisions as an investor is, do we want to invest in tokens or do we want to invest in equity? And you can see right in the middle there is the investment choice where we're looking at, well, if we invest, on the bottom side, we buy a certain amount of equity, that's equity ownership. By the way, it's uncertain because you're going to raise follow-on rounds and additional uncertainty. But that ultimately drives our calculation of equity value. And if we buy tokens, likewise, we can know what the token ownership is initially, but then there's future uncertainty around token dilution. So this is kind of a big map, but two insights out of this. So when we evaluate companies doing ICOs, we find that biggest driver of whether we want to be in the equity side or the token side is the business model, that lower left-hand corner. And if you have a business model that actually even like 1 or 2% of the value you're creating, you're able to transact in a business model, the equity value dominates the token value, with one exception. And that's the very top, the speculation multiple. So it may be that you're creating substantially more value in the equity, but because of speculators in the market, the token values get overvalued, from our point of view, by sometimes orders of magnitude. And so, by the way, you see that last little bit we have in our last little box, equity token conversion. So our general preference is to invest in equities, but if something silly happens to the token value, we'd love to be able to convert in tokens and exit there as well. So that's the quick overview.
Well, on that note, Jochen, you're just in the process of putting Healio, what's it called? It's not Healio, it's Healio, right?
Healio.
Healio, you're just putting it together. And you have experience with quote-unquote traditional startups. What's been the biggest difference for you as you put this new object together?
Well, I mean, in my personal life, I have more experience with the equity investors in traditional startups, so that's a familiar process, and that's been great. Where we are at right now, we need to have a global reach. We need to put many pieces together. And our motivation for tokens is hopefully not speculation, but actually creating sort of network effects that are inherent in the way genomics works. So the challenge has been to find investors that are comfortable being both on the top of your slide and at the bottom of your slide, or at least thinking about both of them. And we had a previous quick conversation, and what turns out is that I quite like it. I mean, I like working in the token world because it's so much more immediate. We are reaching out to people every day. We are under scrutiny every day. People want to know what we're doing almost on a daily basis. And so it's been hugely helpful for us to talk to both sides of the coin because we get the long-term perspective, the very analytic, what's your business model, what's your projected valuation, etc. On the other hand, I think there's a sort of open source community aspect to tokens that's been really helpful for us. And especially if you're doing something new like Healio, trying to put together healthcare, genomics, clinics, etc. Instead of sort of, we learn from people through the token interaction. So that's been a benefit for us, and the proposition's benefit for equity investors is that you actually get to look inside what we're doing at a much higher resolution than you would ever get if you just put money in and talk to us every 3 to 6 months.
Right. Well, Ben, as a more professional economist, what do you think about this?
So I want to touch on a point that was made earlier about the importance of the business model. Just kind of piggybacking on that idea a little bit. One of the things that I think about a little bit, and a lot of people in the space think about, is kind of the concept of crypto economics. And a good crypto economic model is what can really potentially drive a great business model. And the crypto economic sphere is defined as, kind of the way in which you code game theory to create a more optimal system for people to participate in. So like one of the things that is really interesting to think about is, what are the different areas of crypto economics? And just to leave you each with some ideas here, I think it's helpful to think about the field of crypto economics in 3 buckets. The first would be like how it contributes to fundraising. The second would be like how it contributes to different types of community development. And the third would be how like in addition to community development, how you can create a decentralized administration. So all those 3 things put together can potentially create a different, really interesting viral business model. On the fundraising side, probably a lot of people in here know the concept of ICOs and the concept of token fundraising. But what's really interesting about using these technologies is the speed at which you can raise money from potentially anyone in the world. So that creates a new type of model. The second interesting part of this is community development, which is very fascinating. So a lot of people talk about digital tokens, raising money, what I just mentioned. But what's also really interesting is the use of the token to incentivize better better participation from all these different types of users in a particular network. So there's a different way in which you can motivate and incentivize a community of developers, users, investors, and so on to really participate in the network. And that can really contribute to a new, interesting, viral business model. And on the third part, the decentralized administration is really one of the more interesting and unique aspects of applying a blockchain to any type of business model, which is you can actually, by the use of a digital token, the use of a complementary currency, you can incentivize a lot of different people to participate and process transactions at a potentially lower cost. So it's a really interesting way. The third bucket is really interesting if you think about the way to incentivize a distributed group of people to come together and process transactions for any type of network. So you have something like, for example, a really interesting example is the example of Filecoin, where it's like through the creation of this protocol, through the creation of this really interestingly incentivized protocol, you can incentivize a whole bunch of different people distributed across the world to contribute their computing hardware to process transactions for the network. And through doing something like that, the business model is really unique because you can compete against existing, potentially, it's still unproven, but you could potentially compete against existing incumbents like AWS, who already have like really established centralized cloud storage locations. So, touching a little bit on the topic of the business model, I think really interesting is if you think about how to apply crypto economics through those three different dimensions, fundraising, community development, and decentralized administration, you could really come up with something that's interesting and unique in the market.
Well, so Clint, what do you think, what Ben just raised, how do you think that will change how venture capital works in Silicon Valley? Are you bullish on traditional venture capital? Are there big changes coming?
So, well, I mean, I've got a little incentive bias here, but yes, I'm bullish on venture capital. And actually, I'm a fan of the ICO markets. I know there's been talk about how ICOs are going to basically eliminate the need for VCs and so forth, which I don't believe. Because I do think there's value in, especially, so I'm an early stage investor, in initially, how do you go to market? Which problems do you solve? How do you build your team and so forth? And from my point of view, I like to get in before the ICO at the very early stages. And when a company does a successful ICO, in my mind, that's great in terms of non-dilutive financing. So as opposed to going and raising your Series A and B and C and giving away a lot of your company, if you've done a successful ICO, you can avoid some of those steps. I would argue you still can't avoid the steps of building a sustainable long-term organization. Everybody faces that regardless of where you get your capital from. But tokens in particular are a great way to essentially raise non-dilutive financing. And the other thing that I'm very bullish on in the token market is what Keem was saying in terms of the feedback you get from your customers. So you think about, is this the wisdom of crowds or the madness of crowds? And in my mind, a crowd is a great way of essentially processing the information given to them. And so the information given to token users is essentially a view of your product primarily and your technology and so forth. So the crowd can process that in a really interesting and high quality way. Now what they can't process, I would argue, is the value of your token. Because they don't have, the crowd essentially, the token holders typically don't have information to your financial plan, how you're hiring, your business model, these sort of things. And these are essentially the pieces of information that, as a venture capitalist, I get access to in a way that's, if you will, private. So I think there's a role for processing information in a public sense and a different way for processing information in a private sense.
Yeah, that makes a lot of sense, especially because it seems that the threshold or the requirements for a successful crypto project, those goalposts are really moving. And it probably is no longer true that a small team of people with no product and a 20-page white paper can go raise a large amount of money. Now in middle 2018, I think what investors are looking for, whether they're equity investors or token investors, those goalposts have changed very, very considerably. And it strikes me if you're a small blockchain tech company, you almost certainly are going to have to bring a team together, raise some equity investment, get a seed, put an object together, generate a very high quality white paper, and then go potentially for a private token sale or other steps. So since the requirements since what investors are looking for, they're getting much more stringent. that would seem to create a much stronger case for a sort of dual model where you have both equity investors typically coming in early and then downstream steps of a private token sale or something like that. Ben, what do you think? You're nodding.
No, I think there's a really interesting flow of fundraising for any early stage token company. I think what's really interesting for companies to think about is comparing that model to the existing model. So traditionally, when you go out and raise money, in traditional startup land, there's seed, potentially pre-series A, B, C, D, et cetera. But in the token world, it's really interesting. A lot of people give the industry a little bit of a hard time for all these companies going out and raising huge rounds, right? You have examples of companies raising 50 million, 100 million, 200 million, et cetera. But a lot of the times, this potentially may be the only time in which these companies can raise capital. So they're really trying to go out and raise as much as possible in kind of these early stages because there might not potentially be follow-on rounds. I think what's interesting to look at over the next 2 years is how token companies are going to potentially deal with the need to raise more capital in the future. And that's something I think any early stage token company, when you're going through design, how you think about the token supply that you're creating, right? How are you thinking about the use of funds? How are you thinking about how much you're selling? And if, for example, 2 years later, something happens and you need to develop more or you need to raise more money, you have to think about, is there an adequate amount of supply in there? Are the people who are holding all the tokens, are they going to be willing to, to sell into the market? So I think it's really interesting to think about the difference between the traditional world and the token world in terms of how much you have to raise initially and how you think about how much you're going to need to raise in the future and where that supply will come from.
Are there good examples out there of how quote-unquote blockchain companies or crypto companies have made the transition from just burning through funds they raised in an ICO equivalent event and actually made a transition to a sustainable business? Are there examples of that yet?
Do you guys have any perspective? I mean,
well, it gets into some design things. If you have a limited number, a capped number of tokens, that creates an opportunity for increasing the value of the tokens. So we're getting closer to the equity model. So I think there are a lot of people starting to think about how do you assess the value of the token. And just to appreciate Clint's comment, the wisdom of the crowds is really there. Because increasingly, I think one person's experience, people do look to equity investors, VCs, to validate their sort of crowd gut feeling about whether they should invest. So I think there's a hunger for information, but it depends on how you design the token. If you have unlimited tokens that can, you have real risks of issuing tokens that are worth very little, whereas if you go with so there are people coming up, I think, who will explain this to us in greater detail as to how we design the token economy to make it worthwhile and make people happy, both on the institutional side and trading side.
So another version of this would be no. I know of no company that's made this transition. By the way, if anybody has examples, please let me know because I'm on the lookout for this. I had a chance to have a conversation with the head of blockchain at IBM recently, and I was asking him exactly this question, which is, okay, where is the real opportunity in blockchain? And IBM's point of view is logistics. So you're shipping stuff in from all over the country into manufacturing. And by the way, I think one of the reasons they say that is because many of these companies are already on some form of IBM platform software, so they can essentially turn this on as an adder to all their existing software. But their notion is like financial services and many other areas, they're many years out before we see any kind of meaningful conversion from an interesting idea to a sustainable company.
Speaking purely as a technologist and someone who cares about distribution and privacy and so forth, the notion that a company can flick a switch and become a blockchain company strikes me as incredibly confusing, right? Because blockchain, it's not like I'm doing a transition from MySQL to DynamoDB or something like that. It's not like flicking a switch. The whole notion of being a blockchain company is that you try to diminish yourself. You're open source. You distribute. And you architect yourself in a way that where all the founders, if they were hit, smushed by a piano, nothing would happen to the system that you've created, right? That's the essence of what it means to be a blockchain company. You have to build the system in such a way that it flourishes and grows and succeeds even without the founders. And the notion that you're a big company who is working with IBM and then you push a button and then you become a blockchain company, that sounds a little bit like they haven't really figured out what it means to be a blockchain company. But that's a whole other conversation to have. Like, clearly, I have strong opinions about this. So one thing that has come up over and over again is this notion of every single person in this room can mint their own currency, and they can use it to do really interesting things that would otherwise have been very difficult. So it takes about an hour to put your token on ERC20, unless CryptoKitties is doing something, in which case it will take 7 days. But in general, you can relatively quickly mint your own token, and you can use it to control access to your email or calendar or whatever else you want to do, whatever incentive structures you want to engineer for yourself. And I was hoping to get everyone's thoughts on what do you think are the most sort of disruptive incentive structures you might create, or where do you see the biggest implications for different types of markets where this ability to mint lots of tokens and make your own currency is really somehow going to change things dramatically? Ben?
I think one thing that might be helpful for the audience is, like, I can give an idea of what the class of an incentive structure is, and you can think about what are the different specific cases of this general class framework. So one thing to keep in mind is a digital token is basically a unit. It's basically a unit of value, and that unit of value, you can design a system by which people trade, people buy, sell, or hold that unit of value in different cases. And depending on how you design the different ways in which people transact in this unit of value, it can create different optimal outcomes for the entire system. That's the game theoretic element of it. And like the way I've thought about it when I've been working through token incentive design systems is, there are potentially 5 different classes. One are the ways in which you encourage people to buy the token. The other is the ways in which you encourage people to sell the token. The other way is the ways in which you encourage people to hold. The other one would be the way in which you encourage people to earn the token in that system. And then the 5th would be kind of the ways in which you encourage people to spend. So there's a lot of different, like if you look at different white papers and you look at different projects, you'll see that different projects maybe hit on each of those in different ways. But I personally think the most successful ones are projects in which you're able to create specific incentives that encourage people to do each of those activities. Because the buying element is really important because you want inflows, you want net inflows into the system. The selling is also important because you want to create the other side of the market. Holding is also important because as you get deeper into this market, you'll see that there's a lot of token valuation frameworks that depend on something called token velocity. And token velocity is like the speed at which people transact that token. So holding is really important into that calculus. And then earning is really important because you want newcomers, participants who come into the ecosystem, to be able to have a way to earn that token. So a really interesting example in the case of Bitcoin, for example, in the early days, anyone could participate by just contributing their computing hardware, and they could earn Bitcoins if they were selected for the mining reward. So the earn element is really important, and also the spend element is important as well. In this economy, how are you encouraging people to actually spend this on something useful? So in the case of, again, going back to Filecoin, which is a really interesting example to think through, people are spending tokens for storing data on other people's projects. So I think like having an understanding of the general framework to think about incentive structures is helpful, and you can kind of pick different specific cases from there.
So I want to make it short, but I largely agree with you, except I find it amusing actually that sometimes the blockchain community, which is so distributed and democratic, is very focused on designing the token incentives and making people behave in a particular way. So our philosophy is actually to learn from what we see, create some incentives, but I'm an evolutionary biologist originally by training, so I want to see it evolve, and we can use algorithms within our system to help it evolve, but I think I'm more looking towards learning from the users than trying to tell them what to do a priori.
So one of the areas that I'm particularly interested in is the ability for blockchain/tokens to unlock the value in illiquid assets. By the way, health data would be an example of that. If you're really sophisticated, you could sell your health data very successfully, but most people don't have that level of sophistication, so the transaction costs, the knowledge costs of being able to unlock that asset essentially means most people don't participate. So other examples would be your house, by the way, a venture capital fund. There are a lot of these illiquid assets out there that are very difficult to monetize. And one of the real advantage of the blockchain tokens, that sort of thing, is essentially to create, I would call it a free market in the asset. So when you have a very small number of buyers and you take a lot of sophistication, you can have essentially misunderstandings and mispricing of risk and value. And essentially, a free market cleans those out. So if there's a misunderstanding of risk and a mispricing of risk in a free market, somebody's going to take advantage of that, and that's going to create a more efficient solution for everybody.
Super. So you've all successfully managed to slightly avoid the question, which is you've given general answers. We've got a little lecture on the 5 foundations of what people do with money and some other general thoughts. But so we're fortunate to have a big developer community here, and presumably there's a lot of people super curious about what kind of specific technologies might be useful, which specific use cases might be interesting. So if you had to place a bet, and maybe don't tell us your favorite secret bet that's going to be your big new company. Maybe if you tell us your second favorite bet at least, to give people some examples they can sink their teeth into. Ben.
Sure, sorry. One thing recently that I've really enjoyed looking at is kind of the concept of decentralized asset transfer. Some people call it decentralized exchanges, but there's I think there's a really interesting future there, because traditionally over the last year, a lot of people have talked about decentralized exchange of things in really the financial concept, exchanging tokens back and forth. But I think something that's really relevant to everyone in this audience is you have to think going forward, if people are creating a lot of decentralized apps, if people are creating a lot of dApps, and each of these dApps are utilizing different protocols. Let's say, for example, you're creating Ben app, and in this Ben app you have 5 different decentralized protocols that you're using, each that have their own individual tokens. It's going to be pretty frustrating for a developer to build on top of that, unless there's some type of programmable API that they can use to quickly transfer tokens back and forth. And that's something interesting that's coming out of the decentralized exchange space, is kind of trying to create this programmatic layer that any apps can use with an open API, so that so you don't have the fear of the platform changing the API on you. But I think that's really interesting. So if someone, this already exists, but you have a protocol out there in which it serves as this layer that makes it easier for dApps to exchange tokens between different services. I think that's really exciting. So that's something I've been looking at. A lot of people look at it in the context of financial token transfer, but I think looking at it in the context of making it easier for different dApps to source different tokens that their app needs.
Well, I was thinking about the same thing in a different context. I think smart contracts are still in the early stages. So I'd like to see an easier way to have more complicated legal reasoning or other logic in smart contracts that makes it more flexible. And the reason I think I agree with you, because that is one of the mechanisms driving better connectivity across the different blockchains.
Just quickly responding to that, I did a little survey in my class, and I said, hey, who in this class knows about smart contracts? And of course, everyone raises their hand. And then I said, oh, who in this class has written a smart contract? And everyone raises their hand, because it was a homework problem or something. And then I said, who in my class has actually used a smart contract for something? And there's silence, and one person raised their hand. And I said, hey, Brian, so what do you use it for? And he got slightly red, and he refused to answer. So it is certainly true. So I don't know what he used it for, and I'm not going to probe. But it's certainly apparent that as of a few months ago, a lot of smart contracts are being written by people who care about the technology or love Solidity or hate Solidity or some combination of the two. But the number of smart contracts being written for actual, for business reasons or for insurance or logistics are still rather small. I totally agree. For a lot of reasons. And of course, there's many companies now trying to make that easier and formally verify contracts and so forth, which is a really interesting area. But Clint, what is your closing thought?
Well, so I mean, you asked me for examples. Can I name a company?
Yes.
All right, so one company we invested in that was just announced was called Figure. They're essentially helping homeowners very easily create a home equity line and essentially get rid of credit card debt. By the way, you can do this with banks, Wells Fargo, Bank of America, but it's a relatively cumbersome process. And their goal is to make it a very simple process. And the blockchain comes in because when a bank gives you a loan, they typically package it up and sell it to some market someplace. And that packaging process creates 1.5% of additional fees, basically trust fees, which is, okay, I've got a bundle of loans, I'm selling it to the market, and the market says, how do we know those are legit borrowers? Oh, we're going to have to go validate that and check the appraisals and their custodian fees. There's a whole set of fees, cost about 1.5%. And their notion is, we're going to put it all in the blockchain, and you don't have to now validate any of this. And by the way, we're going to still charge you for us, but we're going to charge you something like 1/3% as opposed to 1.5%.
Mm-hmm. Good. Well, thank you, gentlemen, for interesting ideas and attending the panel. Thanks.
Thank you.